What if you could lock in tomorrow's price today without buying the asset and use the very same contract either to reduce risk or multiply it? That is the power and danger of derivatives. In this lecture, we will uncover how forwards and futures transfer risk, why hedges sometimes fail, and how one small contract can reshape the risk of an entire portfolio. A derivative security is a financial contract whose value depends on something else. That something else is called the underlying asset or underlying variable. It may be a stock index, a bond, a currency, an interest rate, a commodity, or another market-related variable. The key idea is simple but powerful. The derivative is a contract. The underlying is the direct economic exposure. Owning a stock gives you direct ownership exposure to a company. Entering a futures contract on a stock index gives you exposure to movements in that index, but it doesn't mean you own the stocks inside the index. This distinction matters because derivatives allow investors and firms to separate economic exposure from direct ownership. You can manage price risk, currency risk, interest rate risk, or commodity risk without necessarily buying, selling, storing, or financing the underlying asset itself. That is why derivatives are so useful in finance. But we must also be careful. The same flexibility that makes derivatives useful can also make them risky. Used properly, they can reduce risk. Used carelessly, they can magnify risk. So in this lecture, we will build the foundation step by step. Let's begin with why investors and firms use derivatives. There are several major reasons. The first is hedging. Hedging means reducing an existing risk. A firm may face exchange rate risk. A portfolio manager may face equity market risk. A manufacturer may face commodity input price risk. A bank may face interest rate risk. A hedge is designed to make those risks more manageable. The second reason is speculation. Speculation means taking a position because you have a view about future prices, rates, or market movements. A speculator isn't necessarily reducing an existing risk. Instead, the speculator is usually creating exposure in search of profit. The third reason is efficient exposure management. Sometimes it is faster, cheaper, or more practical to adjust exposure using derivatives than to buy or sell all of the underlying assets. Derivatives also help transfer risk. One party may want to reduce a risk, while another party is willing to take that risk. And finally, derivatives contribute to price discovery and arbitrage. Their prices can reveal information about market expectations and relative valuation. The important lesson is this: a derivative isn't automatically conservative or aggressive. The purpose depends on the user's total position. So always ask, does this derivative reduce a risk that already exists, or does it create a new risk? Now, let's focus on forward contracts. A forward contract is an agreement between two parties to buy or sell an underlying asset at a specified future date for a price agreed upon today. The party that agrees to buy the underlying is called the long forward. The party that agrees to sell the underlying is called the short forward. The payoff logic is very intuitive. The long benefits when the underlying price at maturity is above the agreed delivery price. The short benefits when the underlying price at maturity is below the agreed delivery price. A forward contract locks in a transaction price. That can be very useful when a future cash flow is uncertain because of a market price. Forward contracts are usually traded over the counter. That means they are privately negotiated rather than traded on a centralized exchange. This gives forwards a major advantage: flexibility. The two parties can customize the underlying asset, contract size, maturity date, settlement method, and delivery terms. But customization comes with a trade-off. Each party faces counterparty credit risk. In other words, one party may worry that the other party won't perform as promised. That is why collateral, netting agreements, and credit controls are important in forward markets. Let's now discuss the intuition behind forward pricing. At the time a standard forward contract is initiated, it usually has approximately zero value to both parties. That means neither side pays an upfront premium in a typical forward agreement. The forward price is set so that entering the contract is fair at initiation, given current market conditions. After the contract begins, its value can change. If the underlying price changes, if interest rates change, if income from the asset changes, or if carrying costs change, the forward contract may become valuable to one side and costly to the other. The basic no arbitrage intuition is based on comparison. One way to get future ownership of an asset is to buy it now and carry it until the future date. Another way is to enter a forward contract today and buy it at the future date. In a well-functioning market, these two strategies should be priced consistently after accounting for financing costs, income, storage costs, and benefits from holding the asset. For financial assets, income such as dividends can reduce the forward price. For commodities, storage and insurance costs can increase the forward price, while convenience yield can reduce it. The main idea is this: the forward price reflects the spot price plus the cost of carrying the asset minus the benefits or income from holding it. Now let's turn to futures contracts. A futures contract is similar to a forward contract because it also creates an obligation connected to a future transaction or future settlement. Like a forward, a futures contract gives exposure to an underlying asset or variable. But the institutional structure is very different. Futures contracts are standardized and traded on organized futures exchanges. The exchange defines the contract specifications, such as the underlying asset, contract size, maturity month, settlement procedure, and other terms. This standardization is important because it supports liquidity. Many traders can trade the same contract rather than negotiating customized terms with each other. Another important feature is that many futures positions are closed before maturity. Instead of making or taking delivery, a trader can usually enter an offsetting transaction. The most important operational difference between forwards and futures is daily settlement. In a forward contract, gains and losses are often realized at maturity or when the contract is closed. In a futures contract, gains and losses are credited or debited through margin accounts every trading day. This process is called marking to market. Daily settlement changes the timing of cash flows. Even if the overall economic hedge is sensible, the futures user may still need cash available to meet margin calls. That is why futures require not only market judgment, but also liquidity planning. Futures markets rely on exchanges and clearinghouses. The exchange provides the marketplace and defines standardized contract terms. The clearinghouse plays an even more important role in risk management. After a futures trade is accepted for clearing, the clearinghouse stands between buyers and sellers. In practical terms, it becomes the buyer to every seller and the seller to every buyer. This structure greatly reduces bilateral counterparty credit risk. Instead of each trader worrying directly about the credit quality of the other trader, the clearinghouse manages the performance of the market through margin, daily settlement, and default procedures. But clearing doesn't eliminate all risk. A futures trader still faces market risk. Prices may move against the position. The trader also faces liquidity risk, because daily losses may require cash payments. There may be operational risk, and there may be hedge mismatch risk if the futures contract doesn't perfectly match the exposure being hedged. This brings us to margin accounts. Futures margin is a performance bond. It isn't the same as borrowing money to buy stock on margin. Initial margin is the amount deposited to open the position. Maintenance margin is the minimum balance that must be maintained. Variation margin is the additional funding required when losses reduce the account below the required level. Margin makes the futures market safer, but it also makes cash flow management essential. Let's compare forwards and futures more directly. Economically, they are similar. Both can lock in a future transaction price. Both can create linear exposure to an underlying asset or variable. Both have long and short sides, but their institutional design is different. Forwards are usually traded over the counter. Futures are exchange traded. Forwards are customized. Futures are standardized. Forwards usually settle at maturity or at closeout. Futures are marked to market daily through margin accounts. Forwards involve bilateral counterparty credit risk, unless that risk is controlled by collateral or other agreements. Futures use a clearinghouse structure that reduces direct counterparty exposure. Forwards may be less liquid, because each contract can be unique. Futures are often more liquid because many participants trade the same standardized contract. So which one is better? The answer depends on the purpose. If a firm needs a highly customized hedge, a forward may be more appropriate. If an investor wants liquid, standardized exposure, a futures contract may be more practical. In many introductory finance applications, forward and futures prices are treated as approximately similar when the underlying asset, maturity, and settlement terms are comparable. But they can differ when daily settlement cash flows matter, especially when interest rates are uncertain and gains or losses are related to interest rate movements. The key takeaway is that forwards and futures share the same basic economic logic, but they manage trading, settlement, and credit risk differently. Now, we need to discuss basis risk. The basis is the difference between the spot price and the futures price. You will see the definition in the visual, and it is important to remember that some market participants use the opposite convention. So whenever you discuss basis, state the definition clearly. Basis risk is the risk that the basis changes unpredictably before the hedge is closed. This matters because many hedges aren't perfect. The futures contract may not mature on the exact date the hedge is needed. The asset being hedged may not be exactly the same as the asset underlying the futures contract. There may be differences in quality, grade, location, delivery terms, or timing. The size of the underlying exposure may also be uncertain. And sometimes the spot price and futures price are highly related, but they don't move perfectly together. A hedge can reduce price risk, but if the basis is uncertain, the hedge may not eliminate all uncertainty. This is a critical point for risk management. A hedged outcome depends not only on the initial futures price, but also on the basis when the hedge is closed. The initial futures price is known when the hedge begins. The ending basis is uncertain, so the manager shouldn't think of hedging as magic. Hedging is a risk reduction tool, not a guarantee of a perfect outcome. Let's now look at the major categories of futures contracts and how hedge direction is chosen. Stock index futures are tied to equity indexes. They are commonly used to increase or decrease broad market exposure, hedge portfolio beta, equitize cash, or manage tactical asset allocation. Interest rate futures are tied to interest rates or fixed income instruments. They are used to manage exposure to changes in rates and bond prices. Remember the basic fixed income relationship. When interest rates rise, bond prices generally fall, and when interest rates fall, bond prices generally rise, holding other factors constant. Currency futures are tied to exchange rates. Firms and investors use them when they face future foreign currency receipts, payments, or asset exposures. Commodity futures are tied to physical commodities such as energy products, metals, and agricultural goods. Producers may use futures to hedge output prices. Users of commodities may use futures to hedge input costs. Now, how do we choose hedge direction? Use a short hedge when the risk is that the price of something you own or will sell may fall. Use a long hedge when the risk is that the price of something you must buy may rise. But don't choose hedge direction simply by asking whether you are bullish or bearish. The better question is, which derivative position gains when my underlying exposure loses value? That question keeps the hedge connected to the actual risk. Finally, let's discuss hedge ratios, contract counts, and the broader risk management process. A hedge must specify both direction and size. The hedge ratio measures the size of the derivative position relative to the exposure being hedged. For a simple direct hedge, the contract count can be based on the size of the exposure compared with the size of one futures contract. When the futures contract isn't a perfect match, a minimum variance hedge ratio may be used. The hedge ratio depends on how closely changes in the spot exposure and futures price move together, and how volatile each one is. If the relationship is strong and stable, the hedge can be more effective. If the relationship changes, the hedge may perform poorly. Futures can also alter portfolio exposure. Equity index futures can change portfolio beta. Interest rate futures can change duration or rate exposure. In both cases, the manager compares current exposure with target exposure and uses futures to move toward the target. A good risk management process follows a clear sequence. Identify the exposure, measure it, choose the right instrument, choose direction and size, monitor the hedge, and evaluate performance. And remember this final lesson. A hedge should be judged by whether it achieves the risk management objective, not simply by whether the derivative position makes money. Thank you for joining me today. I hope this lecture helped you understand forwards, futures, and hedging more clearly.